Hello, it's great to be with you again for our latest investment update. Now, in my last video, recorded in early August, I addressed a concern that was top of mind of very many of our clients. Had the recovery from April's equity market lows simply gone too far, too fast? I reassured you then that while the pace of the rebound was certainly eye-catching, it was underpinned by solid fundamentals, not speculative excess. And I explained that our investment process is designed to navigate both the risks and opportunities that come with such rapid recoveries, always with discipline and resilience at its core. Now, since then, we've received a number of messages from clients who were previously nervous, but have since felt reassured by what I said, giving them the confidence to stay invested and avoid the pitfalls of trying to time the market. Thank you for your feedback. It's always appreciated, and it helps us ensure we're addressing the issues that matter most to you. So today I'm going to build on those themes, providing an update on markets while discussing the key risks, sharing how Rathbones continues to invest with your financial goals front and center. Equity markets have continued their upward march since the August video. For some, this can feel unsettling. Shouldn't we be worried when markets are making new highs? But it's important to remember that markets should be making new highs when the backdrop is as supportive as it is today. Just look at the facts. Profit margins are at all-time highs. Inflation, while above central bank targets in some regions, is relatively low and showing signs of continued moderation. Oil prices remain subdued and, crucially, interest rates are coming down. Credit spreads are tight. That indicates confidence in corporate balance sheets, and banks are lending more freely. Earnings forecasts, they're being revised higher, and leading economic indicators, including our own proprietary models, are rising too. So when you put all of these pieces together, it's no surprise that valuations are elevated. Those valuations are justified by the strength of the underlying fundamentals. And our process is designed to systematically assess these factors, ensuring that we remain objective and evidence-based, even when headlines might tempt us to do otherwise. Because perhaps no question divides investors more than whether it's wise to invest when markets are at record highs. It feels counterintuitive. We're told to buy low and sell high, right? But history tells a different story. Since 1980, investing in the global equity benchmark on the days when it had made a new record high has, on average, delivered substantially higher returns over the following 3 years than investing on any other random day, with the probability of a positive outcome being identical. Now, record highs combined with weak corporate earnings momentum, that's a red flag, but that's not where we are today. Our checklist-driven approach to asset allocation, that's designed to ensure we don't disregard opportunities just because they feel uncomfortable. We rely on evidence, not emotion, to guide our decisions. Now, as I discussed last time, the key risk to the US market remains a reversal in the extraordinary expansion of return on equity among the technology giants that dominate the US index. And I cited our research demonstrating that greatly expanding capital expenditures tend to be associated with lower prospective returns, even when the company is highly profitable to begin with. But that's not a universal law, and is not the only factor that determines performance, of course, and these giants score well on most of the others. But it isn't something to dismiss, especially when our gauge of the number of firms that are monetized in AI has plateaued for some months. Ironically, we use AI to capture that information. Other research papers have also confirmed our history-informed prior that adapting to new technologies does take time. The really good news, though, is that we're seeing a broadening in US corporate earnings beyond the AI-aligned giants. US equity markets year-over-year earnings growth was up 12% in the second quarter, beating expectations. And while in years gone by, earnings growth was paltry when you stripped out the so-called Magnificent Seven tech stocks, this quarter it was still 8% when excluding them. And this marks one of the highest growth rates in recent quarters, with the gap between the tech giants and the rest of the market narrowing. This broadening of earnings is healthy, and it supports our diversified approach. The second key risk is that investors may be underestimating the likelihood and potential impact of an economic downturn. This was a recurring theme in our latest round of asset allocation committee meetings throughout the first week in September. While leading indicators have rebounded and global growth remains resilient, there are still pockets of weakness, particularly in manufacturing and some labour markets around the world. Our forward-looking US recession models currently put the probability of a recession there at around 20 to 30% over the next year, higher than the long-run average, but still very far from a base case. In the UK, the probability is a little higher at 35 to 40%, reflecting recent softness in employment data and the ongoing impact of fiscal tightening. Europe sits somewhere in between the two with a risk of around 30%. Now, at Rathbones, we don't pretend to have perfect foresight. Instead, we build resilience into portfolios through diversification, quality, and a disciplined process that's designed to weather a range of scenarios. I highlighted last time how we like European equities in this regard, where the bar for earnings growth has been set too low in our opinion. And in my last video, I mentioned Japan. I've promised I'd say a few more words about it this time. Japan remains a land of compelling opportunities, particularly as a global leader in robotics and automation, and it's one of the few markets where value stocks routinely outperform, providing useful factor diversification against the expensive US market. Having outperformed US equities so far this year in both local currency and especially in sterling terms, we think there's a good opportunity to take some profits in Japan, however. We've been enthusiastic about its reform agenda for many years. It saw return on equity at the average Japanese firm start to really catch up on that of the average global firm, but progress has stalled more recently, and uncertainty around monetary policy as Japan exits its long-standing low inflation regime, and fiscal policy as the largest political party, the LDP, doesn't control either house of Parliament for the first time since the mid-1990s, has introduced more volatility too. I also said I would say a few more words about UK inflation and UK bonds. Regular viewers will know our conviction in holding shorter maturity government bonds to temper equity risk in our balanced portfolios. That's because a myriad of structural forces, geopolitics, climate change, demographics, government debt, deglobalization, they're likely to make inflation, interest rates and long bond yields more volatile and increase the number of episodes in which longer dated bonds and equities sell off together. In the gilt market, we still think shorter duration positioning makes sense cyclically too, tactically. There are risks to the inflation outlook in both directions, and on balance, a sensible base case is that inflation will be lower this time next year, that's what the data suggests, but it may rise further in the interim, which might surprise the market. Longer-dated gilt prices have continued to fall this year, and this may reflect concerns about UK government debt too. My colleague Adam Hoyes has written up an excellent explainer on UK debt and putting it in the context of the global bond market, which you'll find in our new monthly Digital Insights series. Please do give that a read when it appears on our website shortly. Later this year, that Insights series will also include a piece on central bank independence, which is possibly being challenged in the US at the moment and causing some concern for some investors. Let's do a quick preview because we are getting some questions on that. First, it's not yet clear that the Federal Reserve's independence will be compromised. The Fed has a number of protections absent from other government agencies. Second, it's not as though independent central banks are flawless decision makers. Third, ever since Douglas North and Robert Fogel won the Nobel Prize in 1993, economic historians have proven many times over that institutions such as independent central banks matter to economic progress. But institutional change is not a market timing tool. A non-independent central bank is less likely to tame inflation if an inflation shock occurs, but it doesn't necessarily tell us that an inflationary shock is more likely to occur than not in the foreseeable future. More on that to come, as I said. Thanks for listening today. To sum up, the market rally is built on many sound fundamentals, proven to be associated with lasting positive returns. We're managing risk actively, however, investing with discipline and always keeping your financial goals at the heart of what we do. The world is uncertain, but that has always been true. Through trade wars, pandemics, energy shocks, and inflation, markets have rewarded patience, diversification, and a clear process, and that's what we offer at Rathbones. That's investing well. Thank you for your trust, and I look forward to updating you again soon. I'm Edward Smith, Co-Chief Investment Officer.